All right, we're going to kick this off. We're going to cover a lot of ground today, and I'm going to try to tag on to a conference call we did here at Belpointe with our advisors around the country. I'm going to show a lot of charts. I'm sure there'll be a lot of questions, and hopefully we can get a few answers. All right, let's look at this first one. S&P 500, pretty standard chart. The good news, it's up and to the right, so the glass is half full. And that green line that you're looking at is blended EPS for 1 year. Blended is looking 6 months forward, 6 months backwards. Currently around $271, maybe down a little bit from what it was a couple of weeks ago at around $274, but all in, pretty good news. I think maybe, some of the concern in the market on this next slide is despite the fact that we're going to have growth of about 14% year on year for 2025, it's not cheap. We're at around 22 times earnings. That's the PE ratio. It's elevated, no question about it. It's not the highest I've seen in my career, but it's expensive. But I don't think that's really the only problem. We are less than 3% below the all-time highs. And I'm speaking to you as of Thursday this week, so I'm not going to have Friday's information or how the market closed on Friday. So, of course, anything could happen. But it's pretty clear there's something weighing on this market. And you can see it really when you blow up that chart. I've painted the down moves in red. It's a candlestick chart. Green is up, red is down. And you can see that big gap down. That was the December surprise. That was a Fed day. December 18th. You can see the volume on the bottom there. That was the highest volume day for the S&P 500 all of last year. So that's not good. When you see a big gap down on high volume, take notice of that. And it's pretty clear we're going to have to get above those highs to kind of repair all that damage. So it's very clear something is weighing on investors' mind and weighing on the psyche of the market. I think we all know what that is. We're going to have to dig in and find out. Welcome to the Money Runner. I'm David Nelson. Stock investors always seem to have something to worry about. Could be earnings, potential recession, geopolitical risk, company risk, systemic risk. But most of the biggest problems for stocks start in the bond market. And that's what I think it is this time. Take a look at this chart of 10-year yields. And this is going back 5 years, and you can see that we are breaking out of that channel and pushing higher. Now, the good news is we haven't touched that 5% level, that peak rate we saw back at the end of 2023. I'm going to have a chart about that and what it meant for stocks in just a second, but we have broken out of that channel. We did have a good day in bonds, maybe over the last couple of days on some what is perceived as better than expected inflation numbers, but this has been a problem, and it's been a problem really for the last couple of months. I'm going to show you when all this started. Part of why this is happening is this next chart here, term premium on a 10-year zero coupon bond. What is that? Kind of wonky stuff. What you're looking at there in that chart, what that chart is telling you is term premium is the amount of return a bond investor wants to get above and beyond a short-term security for taking the risk of extending his duration. And you can see that this has been trending higher. And now this chart goes back several decades. It goes back all the way to 1990. And you can see that we've broken that downtrend. In fact, if this was a stock chart, I'd want to buy it because that looks like it's breaking out and it might push higher. And that's bad news for stocks. Higher yields generally means lower multiples. And if we're going to have lower multiples, then that means the earnings growth has to be that much higher for stocks to support themselves. Now, we had a fair amount of inflation news this week, earlier in the week. The first one up was the PPI, Producer Price Index. This chart goes back 5 years. Now, I'm told it was better than expected, but this chart does not give me a lot of comfort. It almost looks like it's trying to break out to the upside here. In fact, on that day, when it was reported, 10-year bond yields, the long end of the curve actually pushed a little higher, kind of a negative here. The better one was the CPI, which came out on Wednesday, and stocks love this news. I mean, we had a monster day on Wednesday, and it almost looked like the bull market of old. Tech did great. Large cap secular growth did great. Financials were killing it. Financials actually started reporting on Wednesday, and for the most part, the numbers were great. BlackRock, JP Morgan, Wells Fargo, Citigroup, all great numbers, and all those stocks pushed a lot higher. Very, very positive day. And yet, we have this weight on our heads, on the market, and we keep going back to it, and we keep looking at what yields are doing, and we keep looking at this chart right here, U.S. yield curve, and it's not a pretty sight, and it frightens stock investors. That yield curve on top, that's today, all right? The yield curve on the bottom isn't that long ago. That's a snapshot from September 16th, right around the time the Fed made its initial cut of 50 basis points. And what was the start off of what was supposed to be a very aggressive rate cutting cycle. And of course, now we've learned that it's not going to be as much as we had thought. Nevertheless, as this become a problem, the 10-year yields since then are up over 100 basis points. That's a substantial move, and it's a substantial loss for any bond investor that was invested on the long end of the curve. Now, bonds are pretty oversold. In fact, I made a trade recently, almost a swing trade, and bought 20-year treasuries for some tactical portfolios. We'll see how that works out. It's designed for a short-term move, not necessarily a secular position that I'm going to hold for a long period of time. But nevertheless, these bond yields are a problem. And in fact, the short end of the curve is a problem as well, because even though we had a monster move in stocks, you would have thought they were moving higher because of an anticipation the Fed was going to be more aggressive on the rate cuts than we had perceived. It's not showing up in Fed fund futures yet. The first chart here you're looking at, that's a snapshot from last week. And that's maybe at most two cuts, 25 basis point cuts from where we are today. Put you somewhere below or around 4% by the end of this year. The chart snapshot on Thursday, the day after that monster move in stocks, almost the same place. So it's not showing up in Fed funds futures yet, just yet. When you're looking at the broad market, the first thing you have to identify is what's working, what isn't, and what's next. And when you look at a sector chart that's up on your screen right now, it is almost the inverse of what we had last year. On top, energy. Energy is killing it, up over 8% year to date. And we're only 2 weeks into the year. Industrial's doing well. Other cyclical sectors like materials doing well. On the bottom, technology and consumer staples. Yet inside that technology sector, there's a lot of stocks doing very, very well. But for most of them, the market caps are a little bit smaller, and it's not some of the usual suspects. Apple had a very bad day today. I'm recording this on Thursday, down over 4%. I think that was maybe the worst day since August. But underneath the tech sector, there were a lot of other names working. One of the tools I use when I'm trying to identify what's driving the tape is factor performance. I run a quantitative equity portfolio called Alpha Select, and factor performance is a big part of the analysis that I need to do for that portfolio. And when I look at factors, I try to look on a long-short basis. where you go long the best part of the factor, go long the worst part. Let me give you an example of that. You're looking at a chart from last year, some of the major factors in a market. Momentum or price momentum was the best performing broad factor last year. It started rolling over towards the end of the year, and you saw that showing up in some of the large cap secular growth names. But in a long-short fashion, you're long the highest momentum, you're short the lowest momentum. The worst performer last year was value, and in that factor, you'd be long, cheap, short, expensive. And the others were somewhere in the middle. Now, so far, year to date, it's kind of early to say. Momentum and growth are there on top, but we're only 2 weeks into this, and it's only the start of the earnings season. And frankly, we have a lot ahead. As a matter of fact, on Monday is inauguration day. Expect a flurry of news coming out of Washington. President Biden, I think, made 300 executive orders right out of the gate. I don't know if Trump will do as many as that, but embedded in those executive orders will be a lot of information, and a lot of those executive orders are going to affect the markets in some fashion. So expect a lot of activity next week. We're going to have a lot on our plate, and we're going to have to examine this in the days, weeks, and months ahead. All right, I'm going to cut it short today. It's late, and I'd like to get home to my wife. Don't forget, if you want to learn more about David Nelson or the Money Runner podcast, please go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is The Money Runner.